Hi everyone, welcome to the Sleep webinar. Hello, how are you? Nice to see you here, guys. Today we are going to talk a bit about trends and Fibonacci studies. So let's start by defining what's trend, right? And of course we should say that it's one directional movement, right? For a quite long period of time. Of course, it will depend on the time frame we are taking a look at. I start with this pound dollar daily chart because we are breaking a long-term trend line. In this case, we are breaking today and we are close today below a trend line that has been developing since early January this year. Okay, so there's three types of trends that we can see in the market, right? And I want to show you this, the euro dollar, this dollar Swiss franc, right? We have a clear bullish trend in euro dollar also developing since early January, right? Where we see that the relative maximums of the trend are higher and higher and higher, right? When the price continues to hit fresh relative maximums and at the same time minimums are higher than previous ones, we say that we have a bullish trend. In this case, you can talk about a minimum here, but next minimum is higher than this one, and next one is higher, and so on, until of course the trend goes up, right? Is this dollar bearish trend giving up, or are we seeing some strong corrective movement? What do you think? We are going to talk about that also. Anyway, and on the contrary, bearish trend is when price maximums, right, become lower, right? Price maximums become lower, right? And at the same time, minimums are also lower time after time, right? Graphically, this is a bullish trend, this is a bearish trend. The third one that we tend to talk about is the sideways or not determined trend, right? Believe it or not, the market has spent most of its time in lateralization trends and consolidations movements and not in strong trends. This kind of trend we are seeing in market these days, since early this year, it's not quite common to see constantly in the market, right? So sideways trend there happens when we can see a clear sequences related of maximum minimums that have no definitions in fact, right? And of course, as an example, you can change any kind of lateralization like this, like this one in here when we have not a defined trend. For example, the clear maximums and minimums overcome each other, right? Until we finally define the trend, of course. Anyway, how do we draw these trend lines? How do we use these trend lines, right? When we are talking about bullish market, like in the case of the euro dollar, right? The trend lines must be showing all the relative minimums, right? Also called values in the pair. Of course, if we are going to use a real chart, like in this case, or we are going to use a graphical representation of all that trend, we are going to see that the chart is not always perfect, right? The chart will not show exactly all the minimums in the middle of the bullish trend, because we have here several intraday minimums, right, that did not reach the trend line. However, the trend is clear because of what we discussed earlier, right? Higher highs, higher lows, daily basis ascending, right? But how do I know if trend line is strong, not strong? How do I determine how to draw that trend line? One, we need at least two minimums to draw a trend line, right? And at least two relative minimums, like in this case. I can choose either to draw another trend line, I don't know, in here, for example, right? On these lows. And I will find that I have more than two minimums to start. I have three, right? Pairs also stop around this area. So it's pretty relative to draw a trend line, right? I tend to try to, right, find a relative an important minimum, like in this particular case that we were coming from a previous bearish trend, right? I try to set that as the beginning point of my bullish trend, okay? Of course, you cannot always do this, okay? Not always so clear in the market. But anyway, that is how it is. I would say at least we need two minimums, right, to draw a trend line. And a third one, will only be there to confirm the validity of our line, right? Usually, let's take an example in here that it seems a bit more clear, right? We have 1, 2, right, points in this bearish line, right, joining relative maximums. And the third one, this one, is the one that confirms the bearish trend, right? Of course, a break of the trend line, which is just a continuation to the upside, right? But anyway, I have chose daily charts in this particular case. Of course, you can apply this to any kind of time frame you are going to trade. Of course, keep in mind that the strength of the certain movement will be more interesting as bigger is the time frame under the study, right? If I don't know, in the middle of that strongly bullish trend we have seen in the euro, I decide to draw a short-term hourly chart descendant trend line, right? What will weight more in market, right? Let's go back to this example. Let's go to this 1 hour chart, okay? I have that long-term bullish trend developing, right? Sorry. And I don't know, maybe one day we have a bearish movement like in this particular case. I can draw a descendant trend line, right? Will that mean that on the third time the pair reaches, it will probably bounce back lower? The fact is no, because the primary trend, the dominant trend, is bullish, right? So I would be rather expecting a break of this trend to the upside than a bounce in here back to the back down. Why? Because this is a short-term trend line, while this is a long-term one, okay? So the dominant trend, the primary trend in this particular case being bullish, right? It's okay. I can draw descendant trend lines in the middle. I should be aware that usually those ones are going to be broken, right? Anyway, what I was saying about the line, sorry. We always said that trend is our friend and that we need to trade the trend, right? So I will be back to the daily chart. Sorry for moving so much the chart. So that means that in bullish market, we must buy to take profits by selling, usually, right? So if any attempt of price to approach to that trend line, we are going to attempt to buy to get profits in higher highs. That's what the basic rule says. But while the trend remains unbroken, right, this trend line remains unbroken, the market trend is considered still valid, right? And if we are working with daily charts and during that session price, I don't know, pass below that trend line, right, but pull back again inside it and closes the day above that trend line, right, we shouldn't consider that a break, and we will wait for further confirmation, because it will depend, of course, on the time frame we are trading. But a spike below the trend line, i.e. the shadow of the candle, will not be usually understood as a break of the trend line, right? It's an attempt. A failure attempt to break, yeah, a failure attempt, but an attempt anyway. Not enough to consider the trend line broken, right? On the contrary, and in the case of the euro, what we have been seeing these last days, right? When the day closed below the trend line, right? And we have a new session or new candle opening, right? Below that trend line, right? We are on our way. Now we will have to have some kind of filter to confirm that the bearish momentum has come to the pair on the side, okay? It's only the line trend, I believe it's not enough, okay? That's what I choose to talk a bit about Fibonacci today, and we are going to discuss it better in a few minutes, okay? But I was following also this yearly rally to the upside sustain of the trend line, right? And if you see, we are just now breaking below the 38.2%, which suggests a bearish continuation in the long term for the euro, right? But the first growth of the trend line is just not enough to talk about a trend change, right? It's not enough. We can see a corrective movement, like in this case, and the pair regaining the upside, and maybe it will overcome again the trend line. In that case, the trend line should be discarded, okay? But we will have to wait, as I would say, until further confirmation, technical confirmation, or I don't know, with a technical indicator that give us a signal in the chart near this couple of candles, right? That would be our technical confirmation, okay? Some prefer to use a certain filter of number of pips. I'm not too happy with that. I don't like it too much. For example, the theory says an 8% of daily range, right? So let's say that if the euro moves 100 pips a day, right, an average, and 8%, right, will be just 8 pips. So that kind of filters that books suggest sometimes, right, seems a bit too poor for me, because in a daily candle we can see shadows for further more than 8 pips to the downside and to the upside, right? So the 8% rule seems not pretty accurate for this kind of trading, mostly for Forex market because of the volatility we've seen in this kind of market. Okay. Anyway, you know, I know in here when we talk about filters, we start with a question and saying, maybe I'm getting in the market too late, right? Maybe I was, instead of selling around 43.10, I will have to sell right now after the pair broke that 38 or this previous low, or I don't know, when the indicator is giving me a signal. Well, that will depend on your temper overall. I believe that our tempers weight on how we see the market. If you are a bit more conservative, well, you will like to wait for confirmation, right? If you're willing to take the risk, well, maybe you won't be waiting for that confirmation. But the confirmation is there just to give you higher mathematical probabilities of success, right? So what will you prefer? Have a good trade with less pips, or attempt to get much more pips but risking higher to loss, right? That will depend on ourselves. Anyway, sorry. Another thing that I wanted to out about how we trade with trend lines, right? When we have a break, we usually see what we call pullbacks, right? That is, price attempts to rise back to the trend line, right? Reaches the area, is unable to break, right, and start losing momentum. That is also another good signal or another confirmation that the trend line is broken. Of course, not all the pairs and not all the time do those kind of pullbacks, right? In the euro dollar, in the pound dollar, we can see nearly 89% of the times when we have breaks of trend lines, the pair or the price action performing a pullback. Okay, but for example, Japanese yen crosses, they hardly do pullbacks. Okay, they hardly do pullbacks, for example. So again, waiting for the pullback after confirmation that the trend line has been broken, right, could make you lose the trade. Okay, could make you lose the opportunity to get into the market because maybe the trend will start developing strongly to the downside, right? While you're waiting for the pullback of 50 pips higher, the price will of 300 pips, like in this particular trade. Again, I believe that that will depend on our temper and our confidence in what we are reading in the chart. But remember, those kind of pullbacks are not 100% staying in the market. Only nearly an 80 when we are talking about euro dollar and pound dollar in between the most traded. Right? Also, it's also another currency that tends to be loyal with what we call technical analysis, right? Anyway, as I was saying, I will have to choose how to trade this one, right? The filter, as I told you, could be the competition of a pullback, a technical indicator, a certain percent of the daily average range, right? But as I was saying, on the other hand, filters tend to lay the signal, so we should not use much than one filter, okay? That's why I would suggest to use a few technical indicators to trade. You can use one or two technical indicators and support your trading decisions with this kind of tools, trend lines, or Fibonacci retracements, right? In a bullish market, we must buy when price reaches resistance and trend line, as I was saying. That's the way we trade, okay? And of course, where will be our stop? Our stop should be just below the trend line, right? The proportion of how much it will be below the trend line will depend on the time frame we are trading, right? If I am trading a 15-minute chart, my stop should be, I don't know, 5 pips plus spread below that trend line, right? But if I'm trading the daily charts and considering that euro dollar again moves on average of 100 pips per day, well, my stop should be at least 40 pips below that trend line, right? So that will depend on where do I place my stop below the trend line. Will depend in the time frame I'm trading and the daily volatility or the intraday volatility of the cross and the sky. Okay, that's something you should consider always. Another thing about trends, and after discussing this, I will make a brief interruption to take your questions, right? It's that generally inside the same chart, you can see different trend lines, right? As I was showing you in the more time frame, we have a descendant trend line. Even in this particular case, we can draw a couple of trend lines downside, right? In this case, and we can draw here a bearish trend line. Okay, I will adjust it a bit more. Okay, there we are, right? Inside the same chart, I'm watching, right? I can see different trend lines. 1, 2, 3, 4 times the pair touches. 1, 2, 3, 4 times till finally breaks, right? We have to define, as I was saying, which is the primary or dominant trend. In this particular case, of course, the dominant trend was bullish one, right? And the other ones, of course, are secondary trends against this dominant one. At some point, this secondary trend, right, will probably turn into a dominant trend. But as I was saying, we need a confirmation of that. In the case of we are daily traders, right, really, meaning we use daily charts to analyze or buy or sell signals, then we will have to define our primary trend, at least in the weekly chart, okay? If we like to trade in the weekly chart, then I will take a look at the bullish to define my primary trend, right? If I trade in the hourly chart, right, in the hourly one, and we'll reduce a bit the charts, then I will jump to the 4 hours one bigger time frame, right, to define the dominant trend. I will take a look at one bigger time frame and see there which is the dominant trend in over the past sessions, right, to define from what side of market will be more profitable for me, right? So if 4 hour chart is bearish, I have a bearish trend line. Indicators are heading south, right? I will change to my 1 hour chart where I do trade, right? And look for signals of selling that particular cross, right? I won't take the chances when the pair maybe breaks against the upside and approach to a trend line, or when it approach to over both conditions in hourly indicators, right? Those is what I do for looking for. But anyway, remember, always one time frame bigger than the one I will choose to perform my trade, okay?